Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right, welcome everyone. You are listening to Your Money Momentum. My name is Tom Kennedy. I have Kevin Curley here, and we are doing our month review podcast, just finishing up October. Kevin, so what's happening?
So much is happening, Tom. Big month. I would say it was the end of the quarter, but it was actually the beginning of the fourth quarter. But seeing some massive sell-offs, some big changes, and lots to go through. So I'm ready to hit the rundown when you are.
Yeah, let's start with the equity market. So we just strung together our third month in a row of negative returns on all the indices across the board: Dow, NASDAQ, and S&P. What are your thoughts there?
Yeah, I think it's just a little bit of an ease, a little bit of a sell-off. I think you've seen a lot of pressure. We saw oil prices rise for a while, and they also saw the U.S. dollar rise a lot. And I think that has a big effect on equities. We saw last year really pricing in a recession, and those drum beats are back again. And maybe this is the other kind of leg down to price in the recession that's coming sometime in 2024.
Yeah, it was a rough stretch, rough 3 months. I think a lot of it, the correlation is back again with to your point, the dollar, but also interest rates. We saw interest rates jump up. They hit their highest level in a while. The 10-year touched 5%. I think a lot of that is just there's a ton of supply being put out there. You have international money, Japan, China, redeeming our debt, flooding the market with treasuries. I think that's a big catalyst to driving these interest rates higher. The Fed hasn't hiked. It's these longer term rates that's having a direct effect, a negative effect on the overall economy, in particular, the market.
Yeah, things are finally slowing down, despite the fact we got a pretty high GDP print, which we discussed. If you look at just kind of a broad measure of stocks, the S&P 500 for the month down like 3.5%. Small caps really taking a big hit at 6.5%. That's I think you have to be careful with small caps. Some of them have ETFs that have only profitable companies and some that don't have to be profitable. And you saw kind of a flight to quality or to value as well. So companies with better cash flow that actually make profits held up better than that. So that's been the playbook for most of the year, is owning quality and then the Magnificent Seven. And I think it's kind of just a continuation of that theme.
Yeah, one reason why small caps really take it on the chin when rates go up is because most small caps, well, they're started with financing. They need to borrow debt to grow. They don't have the cash flow that these larger cap companies do. They're not as developed. So when rates go up, financing costs go up, and that's a big line item in the bottom line. You're looking at small cap companies. So it's been a big discrepancy between the Magnificent Seven and the rest of the stock market. In fact, more than half of the stocks in the S&P 500 are actually down year to date. And it's just those 7, maybe 8 stocks that are really, really driving the returns.
Holding the weight of the world on their shoulders. But styles mattered as well. So one of the things that has been popular the last kind of decade is factors. And so things like quality, volatility, momentum, dividend yield. If you look at that just year to date, quality is up a significant amount, over 17%. Volatility, minimum volatility or low volatility stocks, they're doing well as well. Momentum, it's been bad, and it's been bad for 3 years. It's been better than bonds, but it's been bad. And even high dividend yielding stocks, those are down a lot. So anything that kind of has had a good year is now struggling. But I'd focus really on the interest rate sensitivity. You saw real estate and utilities as far as sectors have the worst time year to date. And meanwhile, things like communication services, information technology, consumer discretionary, stuff that's less reliant on financing, they're doing really well. And then somewhere in the middle is everything else. So anything cyclical. So your industrials, your energy, materials, financials, those things are just kind of putzing along, kind of not doing a whole lot at all.
Yeah, speaking of interest rate sensitivity, bonds are in the longest drawdown, 39 months and counting. By far the longest in history. The second longest being back in the early 80s, there was 16 months. So you look at 3-year returns on bonds, they're negative, which is really,
It's
really
awful. Big negative too, like 5, 6% per year for 3 years.
it's your safe investments, and I think we might have mentioned this on the last call, but I mean you have things like TLT, which is the 20-year Treasury ETF, 10 and 20-year Treasury ETF,
Down half.
more volatile than asset classes like cryptocurrencies. So it's I don't know if the pain has been felt and if the pain is done, or if bonds are broken, but I think we can continue that conversation.
Yeah, surprisingly though, if you look at housing prices, they hit an all-time high in August. And so the reason we bring up August for a November release is very simple. They have delays in the data. And so home prices hit a record in August despite interest rates. This is a time where everybody's in money markets, cash is king, uh, but houses still go up.
Yeah, I think there's a lagging effect with the housing market. I'm actually surprised prices have stayed where they're at based on interest rates, and it's like we talked about before. You have that lock-in effect. The supply is still very low. It's extremely low because people aren't selling. They're not trading in their 3% rate for an 8% rate. Builders aren't building as much because the cost to borrow is much, much higher and it's not as attractive. So you have this supply effect, and demand has kind of stayed stagnant, which I think is going to keep prices. I don't think you're going to see a 15-20% crash in housing prices. I think there'll be pockets of it maybe around the country where job growth is scarce, but it's amazing how prices have kept up when you have mortgage applications, the lowest level since 1995, I want to say, or 94, I think the stat was.
Yeah, along those lines, I think that people haven't been scared away by interest rates as much because they expect them to eventually go back down. And if you're somebody who's applying now, getting a 7 or 8% mortgage rate, your likelihood of refinancing at some point in the next 10, 20, 30 years is really, really high, like well above 90% chance that rates at some point during the life of that loan will be much lower than 7 or 8%. And so I think some buyers are saying, well, I'll pay this for a couple of years and then I'll refinance, which can be a dangerous game. So make sure you can afford your monthly payments. But otherwise, if you're taking a loan at 8 just to get in the house, it can be okay when interest rates fall and you're in refinancing it 4 or 5%, and now you have a monthly payment that's more manageable.
Yeah, and speaking of refinancing, kind of to switch gears on the corporate side, you have this massive debt wall that I haven't heard too much talk about it as of late, but
Mm.
you have trillions of dollars coming due in 2024 and 2025 with these loans that were issued years ago, next to nothing, where interest rates were low, are all coming due. These companies are going to have to refinance at much, much higher rates. So unless rates drop drastically in the next 6 to 12 months, I think there's going to be some more pain to come on the corporate side.
Yeah, recently, well, each day of the week, the Financial Times has a whole section called the Big Read, and the most recent week was one all about that rolling over the corporate debt and talking about how much of there is and how much has to be structured. And it is exactly what you called it, a debt wall, and it's going to be hard to them to get over. And this is a time where interest rates are higher. So what I saw was that money market funds hit a record of over 5.5 trillion in assets. That's a huge number. And I also saw that institutional investors are holding over 20% in cash. Let's get some commentary on that, and then I have some follow-up questions. I mean, 5.5 trillion, that's a lot of cash on the sidelines, Tom.
Why wouldn't you? When you have money markets paying 5.5, that's pretty sexy to me, in my opinion. In this type of environment, when you don't know what's going on, you got valuations, you got the S&P almost at not far off from all time highs of 4,800. Um, it just starts to look attractive, and there's going to be there's this break even point where people are fleeing bonds, they're going into money markets, but there's going to be a point where rates get high enough where bonds are going to look really, really attractive at these current rates, and you're going to have a natural bid and demand. So I think there is going to be some sort of ceiling on interest rates. Interest rates are going to go up until you're just going to have a massive bid and a lot of buyers come in, both institutional, sovereign wealth funds, pension funds, endowments, retail, and that's going to naturally suck out the supply that the Fed and others have been dumping into the market. When you take out the supply, the demand goes up, and as demand goes up, prices go up, and the inverse happens with rates. The rates will go down regardless of what the Fed does. I don't care what the Fed does. It's why you have flat curves, inverted curves, straight curves. It's what the back end of the curve does in the longer term rates. I'm keeping an eye on. I think there's going to be a time where it's just going to look really, really attractive. I mean, look at municipals, tax free. You can get. I mean, the rates are getting up there.
Yeah, tax equivalent yields are over 7 or 8%, depending on how far out you want to go on your maturity levels. I think that this is a good pausing point to talk about our 5 good minutes topic, which this month is reinvestment risk. Reinvestment risk. Tom, think we can do 5 minutes on reinvestment risk?
Yeah, yeah. Kick it
All
off.
right, so let's define it, which is something you were just getting into, which is rates are high right now, and a lot of people are hiding out in government money market accounts. Why does that matter? Well, each month, sometimes more often, sometimes less often, they're going to change the rate that they pay you out. So if the Federal Reserve were to cut rates or prevailing interest rates, especially on the long end, were to fall a lot, you're suddenly going to go from getting 5% on an annualized rate to maybe 4 or 3.5. Every time we have a Fed meeting or a Fed release, or recently it's been more the inflation releases, 20, 30%, basis point moves happen across the entire Treasury curve. So if that's happening at the Treasury curve, all of these other products are going to get priced accordingly. So you may wake up on a Tuesday, rates are at 5, and on Wednesday they're at 4.8. So you have now lost the chance to go invest at those higher levels. Let me give you a real life example. So this summer, the UK market's called gilts. It's the equivalent of their short-term notes for our U.S. Treasuries. Their 2-year yielded 5.5%. That was back around July or August. It's now down to 4.5%. So if you were investing back then, you could invest at 5.5% for 2 years, which is pretty good. You're guaranteed that. A few months later, when you go to do it, you're only getting 4.5. Now, if you have $1 million, that ends up being a lot of money. If it's, let's say, $100,000 to make it more reasonable, you're going to lose out on a tremendous amount of interest just by waiting around. And this is important because everybody's sitting in government money markets. It's a great deal today, but a year from now, prevailing interest rates are at 2 or 3. You could have locked in a U.S. Treasury, a UK gilt, something else that's also safe for 4 years, 5 years, 7 years, 10 years, and guarantee yourself 4, 5, 6% for the next decade, as opposed to sitting in cash equivalent of the money market for 5%, and you might not have that months from now or a year from now.
Yeah, I think it'd be fair to say, just to sum it up, that a money market is a 30-day rate. It typically changes every 30 days, up or down, or stays flat depending on where the Fed funds rate is. And to your point, a year from now, the Treasury market or the bond market is pricing in almost a 1% cut from where we're at today, is from the last numbers I looked at, which you'd be at, if you're at 5.25 in a money market, 5.3, you're at now 4.3. So to your point, now the give and take is you have full liquidity, full flexibility. You're not locked in. You can go in and out of that. Whereas you buy a 2-year bond or a 3-year bond or a 10-year bond, you're locked in for that duration, which isn't necessarily a bad thing because, again, locking yourself in to get 5%, what most would call risk free with treasuries, meaning they're not gonna default. You will have some fluctuations as rates go up and down, but the idea is to hold it to maturity anyway. Is not a bad idea. I think that time's coming soon. I think you're starting to see people dip back in to the bond market to take advantage of that. And reinvestment risk goes both ways. You want the opposite to be true with when you have debt. You want the lowest rate locked in for the longest period of time. Um,
Yeah, I've
so
got a good story from Howard Marks's recent memo. He talked about coming of age as far as an investment back in the 70s and 80s. And he said, I think it was an aunt he was having dinner, it was like a Thanksgiving meal, some type of big meal, a lot of people at the table. And she was more or less, not bragging, but letting everybody know what a great investment she had just made. She bought a CD, incredibly safe, backed by the FDIC, et cetera. And she had locked in a 17% rate. And he said to her, well, what are the 5-year and the 7-year pay? She says 14%. It's like, well, we should have done that. Goes, why? I'm getting 7%, 17% this year. He goes, yeah, but 17% this year is great for 1 year. You could have locked in 14% for 5 years or 7 years. And she didn't understand the value of getting that lower rate for more years. And it's really just the effect of compounding. So if you can keep a higher rate for longer, that's going to end up being a lot better than kind of doing what a lot of bond traders are going to have to do over the next few years, which is just relative value, saying that yeah, treasuries are good today. If they go down, they'll just kind of go to high yield, or they'll go to leverage loans, or they'll do something else, just kind of where the relative value is. If you're an individual investor, you need to think longer term of how long can I get this 4, 5, 6% rate. If you can get it for 5 or 7 years, that can make a really nice impact on your ultimate underlying performance.
You bring up a good point too. The biggest thing about reinvestment risk is just that in 5 years when those bonds mature that you're picking up right now at 5%, when that money matures, you need to go back in the market and buy a new bond. Well, that new bond might now be at 2.5 or 3%, or it could be higher if rates continue to go up. I doubt it, but it could be a lot lower. So if you're depending on that income stream as part of your fixed income for retirement, you're really the big challenge for you, and the big hurdle is this reinvestment rate. When these bonds do mature, going back into the market at where current rates are, and you can take a big cut and pay, which is why you don't put everything obviously in one basket. You have other sources of income and pension streams, if you will. But I think that is reinvestment rate risk in the
Valley
nutshell.
sells seashells down by the seashore, right? But I think that it's something that's often overlooked, and there's a few reasons why. One, for 15 years, it hasn't really been a thing with interest rates at zero. The future always looks brighter. The other part is that I don't think investors feel the same pain of missing out on gains the way they do when they hit losses. And reinvestment risk is really saying you're going to miss out on future gains by taking kind of the safe, easy 5% today. Go ahead and stretch a little bit, go out further on the duration, and you might be locked in at a higher rate for longer. The other thing you could do is consider a strategy like a barbell, where you're buying some of the short term, like money markets, and some of the kind of intermediate or longer duration, and that way you have both sides. And if rates go up, then great, you can invest some of that short term money into more long term as it keeps going, and you're protected for some of those losses. And if rates go down, you're still benefiting from the drop in rates on the long end, and you still have the opportunity to invest. And you didn't make as much on the short end, but you made a lot more on the long end because bonds will price according to prevailing interest rates. So it's a little different than CDs in the sense, or money markets in the sense that you can get that bond gain just by rates changing as they rise or fall. You might be able to capture that loss or gain versus the CD. It is what it is. There's not a whole lot to it.
Yeah, and what you're describing is bond laddering, and we haven't talked about it in probably over 15 years because of how low rates have been, but it's an actual proven. I mean, it's a strategy that works, and it works really well if you do it effectively and you know how to ladder out the bonds. And I think it's good for a good portion of the portfolio, depending on what your ages, target of income, etc. So.
Yeah, and then the other piece I would say is you mentioned municipal bonds. There's some really great opportunities, I think, in municipal bonds because so many of them looked out across the landscape a few years ago and said, we can borrow money for 2% or 3%. Let's issue as much debt as we can. And now, because of interest rates rising, some of that debt is priced at 60, 70% of par value, but the coupon's 2%. So the city or municipality or the toll road, whoever it was that issued those, they're going to only pay 2%. Yet you might be able to pick up 5%, and on a tax equivalent yield, might be it's worth 7.25 to 8%. So they're not going to refinance those because who's going to cash in two when prevailing interest rates are 5 or 6? Even if rates go down, they're unlikely to go back down to zero. So some of those cities and municipalities that issued at two, they're not calling those bonds because they want to pay 2% forever. But you as an investor, because of rising rates, might have a chance to pick up a really nice thing, and you don't have to worry about getting called on them.
Right, right. And you have general obligation, you have revenue, which is backed by the revenue of the municipality. And in general, historically, they have lower default rates, per
Hmm.
their credit quality versus their taxable counterparts. And default rates right now, not that they can't pick up. I mean, that's one of the risks of buying an individual bond is that you don't get paid back at maturity because the company or municipality that you invested in goes bankrupt. Default rates are at all-time lows. So the biggest risk is if you have to get out of that bond before the maturity ends and rates are up and your bond prices are down and you take a loss. But if you can hold to maturity, you're going to clip your yield, get your coupon, and let it roll off. And I think that makes a lot of sense right now based on the low risk of default, especially the municipal side and where rates are at.
Yeah, so Moody's has a report you can find on their website. It's over 100 pages long, but I read it on a flight recently because the flight seemed to take a lot longer than I realized it was going to be. And they found about, we'll call it about once a year on average, there tended to be a default. And it's really kind of depends on the sector. So they had a lot of problems with healthcare related entities as well as housing, kind of public housing type of projects. Uh, Otherwise, they really don't default. And they found that within the prior year before default, it had to be rated BA2 or worse, or they just really don't default. It's incredibly rare. There were some exceptions, like Orange County defaulted even though they had a high credit
Yep.
rating, and it was done more as a strategic option. They had a lot of kind of Catholic municipalities that were concerned about some of their liability that defaulted in advance just to kind of negotiate with creditors. So outside of a couple strategic ones, the risk of default is incredibly low. And look, if you own a sewer or a municipality water system, they just raise the taxes because people are going to still need those two things. And for general obligations, it's not even a state, but Puerto Rico's been the only one that's really had a major problem. Often cited are Illinois and California for ones that are at risk, but by and large, states, municipalities, they hit their budgets, they pay their bills, and they tend to be pretty highly rated. So if you're looking for something to avoid reinvestment risk and you want some higher quality than maybe some corporations offer, munis can be a really great choice.
Yeah, and I'll end on this with the default stuff. It's like an upside down hockey stick. The closer you get to maturity, the lesser and lesser likelihood of that bond defaulting. And not only that, but even if the issue does default, as far as creditors go, you're almost at the top of the list. So it's not defaulting, you're getting zero back. You might get 60, 70 cents on the dollar. So it's not like it's defaulting and you're getting nothing. You are recouping some of those funds back. So to your point, not that it can't happen, not that it can't go to zero, not that the defaults can't pick up across the board. It's just historically highly unlikely, and it's been a great place to generate some tax-free income.
Yeah, and look, there's a lot of detail and nuance to it, so make sure you work with an advisor or somebody very qualified before you go and just buy a bunch off the shelf. But that was great. Should we move on to some bold predictions?
Let's do it.
Get your future freezing cold takes as we launch into our latest series of Bold Predictions.
All right, Tom, last month I told you CJ Stroud was going to be Rookie of the Year. He's thrown for like a dozen more touchdowns. He beat the Bengals last week. He had an unbelievable comeback in a game the week prior to that. So, that one's looking good. You got any good futures bet for me for Heisman or any awards in the NFL?
I think you're right with TJ Stroud. I mean, those last couple of games were really, really, really impressive. I think he beat out Mahomes for rookie throwing yards in a single game, which was really impressive. And coming back under pressure like that. Bold predictions. Unfortunately, my Colorado Buffaloes aren't looking too hot. I thought
no bowl game.
I don't think they're going to get a bowl game. It's not really a bold prediction. It's pretty apparent at this point. But that's all I got for you. Is I'm pretty upset about my Buffaloes.
All right. Well, as far as markets go, how about a bold prediction on whether or not rates have peaked?
I don't think they've peaked. I would love and I would want to think they've peaked, but I think you still have more to go. I don't think that buying has started yet. And you have the Treasury that's still unwinding, that's still selling. You look at, and I haven't fact checked this yet, but just international money, China, Japan, just dumping treasuries. That yen carry trade's unwinding. It's not as attractive as it was. So without a natural buyer and a ton of money out there, I think rates are going to continue to go up. Now, the Fed funds rate, I do think is peaked. I don't think the Fed's going to raise from here. I don't think they're going to cut as soon as everyone thinks, or the bond market's saying they're going to cut. But I think they're done on the raise.
Yeah, I think the market thinks they've peaked. I do think inflation's still a problem, and if it does kind of roar back up a little bit higher, I think you'll see them raise rates a little further. But I'll go with your prediction that it's basically done, but not maybe quite done. I like the non-committal answer. So next time we'll be talking about the central banks. We'll get through the Fed, the Bank of Japan, which you alluded to. We'll talk about maybe some end of the year planning or some tax changes coming up. So join us for our mid-month pod coming up soon.
All right, thanks, Tom.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.